It's countdown to the CBN's Monetary Policy Committee decision announcement. Thank you for staying tuned. I'm Chimeze Obi. Well, the Central Bank Governor Godwin Emefiele will, in a very short while from now, announce the decisions of the Monetary Policy Committee at today's meeting. In the meantime, here is what the committee did at its last meeting in September. The committee voted to hold all policy parameters. The MPR was unchanged at 11.5%. The CRR was retained at 27.5%. The asymmetric corridor was maintained at plus 100 and minus 700 basis points around the MPR, and the liquidity ratio retained at 30%. Well, I still have with me here the immediate past Director General of Lagos Chamber of Commerce and Industry and the CEO Center for the Promotion of Private Enterprise, Dr. Muda Yusuf, and of course on Zoom is a Professor of Economics and Public Policy at the University of New York, Professor Atman Ewo. Thank you very much, gentlemen, for sticking on the show. Okay, Professor, starting off again with you. The FX market remains the big elephant in the room. Well, in its latest Article 4 consultation report with Nigeria, the IMF seems not to agree with the central bank on the administrative measures it has taken to address the persistent foreign exchange shortages, and says it's negatively impacting confidence. You remember the CBN at its July meeting banned the BDCs from accessing FX from official market, and at its September meeting also banned Aboki FX from publishing rates. What's your take on this, and do you see this as a major consideration at this meeting?
Well, thank you very much. Well, I'm sure they will look at the exchange rate matter, but again, the IMF talked about we needed what they call a fully unified market clearing exchange rate. I'm sorry, I have to disagree again. I support the CBN's managed float. It's not really administrative, it's a managed float. They look at the market of the forex market and then determine when to make a adjustment, because ab initio, the foreign currency is not our currency, so you have to manage it. The naira is not convertible. The only way we can get out of this is to have an economy that is productive, diversify your economy, be industrialized, and end foreign exchange outside of oil. Talking about a fully unified exchange rate that is market clearing, in practical terms, I don't see that being possible. Why I don't support multiple exchange rate regime? I think a managed float is the way to go. And I hope the CBN will not change its stance on that. Because if you float the naira, you see what will happen to the rate of inflation. And there's nothing wrong in if trying to assist SMEs or whatever in giving them some special rates, but to allow the market to determine the exchange rate of the naira vis-a-vis the dollar or other currencies, I think at this point of our economy it will be suicidal. Because people forget that the competitive market system or the competitive market system, they call it, or the equilibrium, there are conditions. There are conditions on both sides of the market. There are conditions. And each, whether you look at the demand and supply side of the forex market, every point there is a price. So there are conditions. For you to say the rate is market cleared, market determined, there must be, it has to be a unique rate, it has to exist, it has to be stable. But the main thing is that that currency, the foreign currency, is not our currency. So you manage it. And I think in this regard, the CBN is right. It's not really, I'm not only brief for the CBN, but it's not administrative. It's a managed float regime where you look at the market and you make adjustments, you know. So the only way we can get out of this is to have a productive economy where your economy produces and exports non-oil goods and services to end forex exchange. Otherwise, this problem will continue. And so in countries that are industrialized or diversified, exchange rate is important, but not too important. They don't worry about it, you know. But in one case, because that variable is what gives us maybe most of our forex and what we use to perhaps finance some projects, which is also wrong, because most of the forex come from oil revenue, as we know. The oil revenue is very volatile. You don't control the price. You don't control the output. How can you now use an additional source of revenue to finance development? And that's why we have to look inwards and change the structure of our economy to be less dependent on oil. So on the matter of a market clear, so-called market clearing rate for Forex, as put forward by the IMF, I don't agree totally, because there are conditions to be met, and those conditions are not in existence in our economy. We don't earn. I mean, we earn dollars by exporting crude petroleum. We don't earn dollars by exporting goods and services, non-oil services produced by our own industries, or even adding value to those products. So I think that's why I said at the beginning that my problem with the IMF is this one size fits all. So we all like the market, but in some instances the market cannot determine everything, because if you give me a oligopolistic market, I will give you an equilibrium.
Oh.
If you give me a monopolistic competitive market, I will give you an equilibrium. So there are conditions we met for you to have a market clearing exchange rate, and those conditions are not applicable in our economy now. So the CBN is to do a managed float, but in doing that, they have to be very efficient and observe the market and then intervene appropriately. That's my position on the.
Okay, Dr. Muda Yusuf. I mean, you're one of those that would advocate liberalized exchange rate. Well, Professor Abadibude doesn't seem to agree with a liberalized FX market. So what's your take here?
Well, with due respect to Prof, I don't agree with his position. Perhaps the IMF may be speaking at the other extreme, but certainly the current model is not working for us. Because
so what
we are talking of, I mean, the Prof was talking about managed floats. Even
Which
if you
the
have
central
to,
bank has been doing,
if you have to manage the floats, the condition of the differential in rate is very important. Because if you have this kind of situation, normally you should have a differential premium of 5%, maximum maybe 10%. But here we are dealing with a premium of almost 40 to 45%. It's a major distortionary problem for this economy. How are you going to allocate it? How? You create problem on the demand side because you have generated a lot of pressure on the demand. Because you have priced, there is so much premium. You create a problem on the supply side because you are blocking those who want to bring in foreign exchange into the economy. It's one of the biggest problems we have in this economy today. Look at what is happening to our FDI.
So how would liberalizing, the markets, I mean, the Prof had just said it, if you liberalize the market, we're talking about high inflation rate.
No, the thing is that...
How would liberalizing the market close this gap?
You can't give what you don't have. Your price must reflect the scarcity. You have to face the reality. If you don't have the FX, let your price reflect the scarcity, and people will make their decisions. People will be able to plan. This is almost taking us to an arena of micromanaging the economy. You look at the, okay, you take Forex, you are not qualified. You cannot, it is not sustainable. And it's creating a lot of abuse in the system. I've had a lot of complaints from exporters. That how can they export? And you say that they should come and be paying them 412 or 413. These are part of the problems. We have people who want to bring in Forex as portfolio flows or as FDIs. At what rate are they going to bring it? At 412? And you want them to bring it in? No, I think it's not a sustainable model. I don't go for extreme, market determination, but we should have a system where the premium between the parallel rate and the official rate is not more than 10%. So that you can have sanity. Because right now, some people's business is just to go to the official window, get Forex, take it to the parallel market window. They make more profit than those who are really doing serious business in this economy. That is what the environment has created. And the process of trying to manage this, there's a lot of micromanagement. It's a question of getting the system to work. And all over the world, the market has proven to be a very effective system. Of course, there are what we call market failures. But in this case, we have not established a case of market failure.
Well, Professor noted the fact that we just have to create a productive economy.
You have to create a productive economy. But even with this, if it is cheaper for you now to get the forex at 412, are you not encouraging more imports? It's an incentive for more importation, and it's penalizing exports. Is that not a problem for the economy? So I think we can, of course, face the issue of building a productive economy. That is why we talk about issues of the fiscal policy role. Mm-hmm. How to deal with the structural problems, how to build infrastructure, how to make our ports more efficient, how to reduce energy costs. Those are the things we need to do. But at the same time, when you are allocating a scarce resources, the scarce resource must reflect the price of the scarcity. Otherwise, you create a subsidy, because what you are dealing with in the FX market is a subsidy problem. You know what we are having, the problem we are having with the fuel subsidy?
All right.
You have the exchange rate subsidy.
I'm being told that
you have electricity subsidy.
The central bank governor, Godwin Emefiele, is already seated and started addressing the press on the outcome of the meeting. Let's cross over now to Abuja, Central Bank headquarters.
For the global economy for the rest of the year and into 2022 remains favorable. The uneven pace of recovery across countries has persisted. This was driven primarily by COVID-19 vaccination rate, size of policy support, and regional economic conditions. On the domestic front, the continued support by the monetary and fiscal authorities is sustaining the growth recovery in Nigeria, notwithstanding the persistence of security challenges and legacy infrastructural constraints. The committee appraised the developments in the global economy, international financial environments, and the domestic economy, as well as the outlook for the rest of the year and the first quarter of 2022. 10 members of the committee attended this meeting. The global economic development. Global output growth has remained upbeat as economic agents defy the continued threat posed by the sharp rise in infection rates associated with the Delta strain of COVID-19 virus. The IMF, on its part, in its October 2021 World Economic Outlook, downgraded, albeit marginally, its growth forecast for advanced economies in 2021. The downgrade was, however, offset by an upgrade of the growth forecast for the emerging markets and developing economies in 2021. Despite the forecast for a robust recovery of the global economy in 2021, the uneven pace of vaccination across the globe and the continued rise in infection rates by the more fatal and mutating strains of the COVID-19 virus suggest that the current two-speed recovery of the global economy may persist longer than anticipated. This may, however, be remedied if governments across the globe rally to improve coordination in the distribution of vaccines to aid the early attainment of global herd immunity. The committee noted that the downside risks to the recovery may persist if the spread of this new variant is not addressed urgently. In light of the above dynamics and associated headwinds, the IMF downgraded its 2021 growth forecast for the global economy from 6% to 5.9%. It also revised the projection for the advanced economies downwards from 5.6% to 5.2%, while the forecast for the emerging markets and developing economies was revised upwards to 6.4% from 6.3%. Inflation across several advanced economies is expected to continue its upward trend in 2022, contrary to earlier expectations of transiency, as commodity prices continue to recover and feeding into energy and goods prices. This is on the backdrop of rising demand associated with a sustained rebound in global output growth amid lingering supply constraints. In response to the persistence of price developments, the US Fed commenced tapering its monthly bond buying program. Other advanced economy central banks have also indicated the likelihood to follow suit in the short to medium term. In key emerging market and developing economies, inflation remained relatively high compared with advanced economies. This is mostly due to supply-side constraints associated with the pandemic, exchange rate pressures, and other legacy structural problems. The severity of inflationary pressures in this group of economies, however, varies across countries in relation to the specific structure and dynamics of the individual economies. In the global financial markets, equity prices largely remained a strong post-lockdown recovery, while investors continued to maintain a sizable hedge in gold, possibly to ease the impact of a rebound of the pandemic as infection rates continue to rise. The financial markets remained undoubtedly bullish, suggesting that investors are cautious of the rebound in infection rates and rising inflation in major economies. Price of gold and other precious metals have remained significantly above their post-pandemic levels, an indication that investors have not fully returned to the financial market. Domestic development. According to the National Bureau of Statistics, NBS, real gross domestic product GDP grew by 4.03% year-on-year in the third quarter of 2021, compared with 5.01 and minus 3.62% in second quarter of 2021 and Q3 of 2020, respectively. The growth trajectory post-lockdown has thus been positive in the last 4 quarters following the exit from the recession in 2020. Quarter on quarter, real GDP grew by 11.07% during the third quarter of 2021, compared with minus 0.79% in the preceding quarter. This improvement in real GDP was driven by growth in both the oil and non-oil sectors by 12.05% and 10.99% respectively. The committee also noted the continued improvement in the Manufacturing Purchasing Managers Index, which, though remained below the 50 index points benchmark, rose to 47.3 index points in October 2021 from 46.6 index points in September 2021. This improvement indicated a gradual recovery of output growth, driven largely by the increase in new orders associated with rising aggregate demand and upswing in business activities. The non-manufacturing PMIs, however, declined to 47.5 index points in October 2021 from 47.8 index points in September 2021 as uncertainties persisted around the poor security situation. Committee noted the continued moderation in headline inflation year-on-year to 15.99% in October 2021 from 16.63% in the previous month, the 6th consecutive month of decline. The decrease was attributed to a marginal decline in both the food and core components to 18.34% and 13.34% in October 2021 from 19.57% and 13.74% respectively in September 2021. Inflation, however, remained above the bank's implicit tolerance corridor of 6 to 9% and above its benchmark policy rate of 11.5% despite its progressive decline. Observing developments in the monetary aggregate, the committee noted that broad money supply M3 grew by 7.1% in October 2021 compared with 4.72% in September 2021. This was driven by growth in the net domestic assets NDA by 9.12% in October 2021 compared with 10.71% recorded in September 2021. Net foreign assets, NFA, on the other hand, contracted moderately by minus 1.5% in October 2021, compared with minus 20.85% in the preceding month. The continued growth in non-net domestic assets was largely driven by increased claims on the federal government and other public non-financial corporations, private sector, and state and local governments. In the financial markets, money market rates oscillated within the standing deposit facilities corridor, reflecting the prevailing liquidity conditions in the banking system. The monthly weighted average open buyback, OBB rate, increased to 12.18% in October 2021 from 11.11% in September 2021, while the monthly weighted average interbank call rate decreased from 13.21% in September 2021 to 10% in October 2021. The increase in the open buyback rate reflected the tight liquidity condition in the banking system. MPC noted the positive performance of the equities market in the review period, with the all-share index and market capitalization increasing to 43,199.27 and 22.55 trillion on November 19, 2021, from 39,219.61 and 20.43 trillion on August 31, 2021. This depicts improved investor sentiment following impressive corporate earnings of listed corporations on the exchange. This led to a new bargain hunting drive by investors. The MPC noted that the capital adequacy ratio and liquidity ratios both remained above their prudential limits of 15.2% and 41.2% respectively. The non-performing loans ratio at 5.29% in October 2021 reflects progressive improvement compared with 5.7% in October 2021. The committee, however, urged the bank to sustain its tight prudential regime to bring the non-performing loans ratio below 5% prudential benchmark. The gross external reserves stood at $41.4 billion as at November 18, 2021, compared with $41.34 billion in October 2021, a moderate increase of 0.17%. Outlook. The overall outlook for both the global and domestic economies remain upbeat, but the significant domestic downside risks clouding the path to full recovery. The key risks remain the unabating COVID-19 pandemic and uneven progress in vaccination. As the US Fed commences scaling down of its monthly bond buying program, there is increased likelihood that other advanced economy central banks will follow in the same direction. With this impending development, external financial conditions will likely tighten for most of the emerging markets and developing economies in view of huge capital flow reversals to the advanced economies as yields rise. This will no doubt deepen the growth divergence between these two groups of economies. Forecasts for key macroeconomic variables for Nigerian economy indicate continuing rebound in growth recovery for the rest of the year. This is expected on the back of continued support by both the monetary and fiscal policy, sustained high crude oil prices, and most importantly, availability of COVID-19 vaccines, as well as high turnover for vaccination in Nigeria. Accordingly, the Nigerian economy is forecast to grow in 2021 by 3.1% CBN estimate, 3% by federal government estimate, and 2.6% by the IMF estimate. Inflation is expected to continue its downward trajectory as the harvest season sets in and the government works on improving the security situation to ease the bottlenecks constraining food supply. The committee's consideration. The committee commended the continued recovery in output growth following a positive outcome in the third quarter of 2021. Based on the current outlook for price development and growth, members carefully reviewed the options confronting the committee in the short to medium term, taking into consideration key downside risks to growth and upside risks to inflation. Members reiterated the need to remain cautious and urged both the monetary and fiscal authorities to sustain their support for the recovery as the pandemic was yet to be over. Committee, however, noted that with the sustained intervention by the CBN, economic activities will normalize in the short to medium term, leading to improved output growth and lowering of inflationary pressure. The MPC also urged the fiscal authorities to sustain the current efforts to revamp the economy through continued support to the critical sectors of our economy. The continued security challenges across the country remained a major source of concern for members, noting its impact on business confidence, foreign investor inflows, and overall economic activities. The persistence of insecurity in major food producing areas remained a key downside risk to our recovery. Committee called on security agencies in the country to increase their presence in order to boost public confidence and facilitate the movement of people, goods, and services across the country. With improved security, especially in these food-producing areas, members expressed optimism that food inflation will drop significantly following successful harvest and distribution. Committee also commended the gradual diversification of the economy with the increased contribution of the non-oil sector to government revenues and called for more support to increase non-oil exports as a source of foreign exchange into the economy. Members reiterated the impact of poor infrastructure on rising domestic price levels, urging the federal government to prioritize investment in public utilities to improve the business environment. These include transportation network, power supply, education, and health. Following the President's recent international call to investors to channel investments to Nigeria, members were of the view that funding of such projects could be sourced through equitable partnerships with foreign investors and Nigerians in diaspora. Committee noted that the equities market remained in a strong position, signposting continued investor confidence in the Nigerian economy. Members thus urged the monetary and fiscal authorities to build on this sustained confidence to attract more foreign direct investments into Nigeria. MPC welcomed the continued resilience of the banking system in the face of severe shocks to both the domestic and global economies, commending the bank's management for maintaining overall stability in the banking system. Committee thus called on the bank to continue to push for increased intermediation as the way forward to reduce unemployment, create wealth, enhance production, and improve aggregate demand to strengthen its recovery. On this note, members applauded the success achieved by the bank's various intervention schemes, which have contributed to both the demand and supply sides of the economy. Committee reviewed the performance of the bank's various interventions aimed at sustaining recovery of output growth and addressing the downside risk to other external and domestic shocks to the economy. Interventions continued largely in the manufacturing as well as industries, agriculture, energy and infrastructure, healthcare, and micro, small, and medium enterprises. Under the targeted credit facility, the bank has disbursed a total of 363.49 billion naira to 766,719 beneficiaries, comprising 638,070 households, 128,649 small businesses. Under its Agribusiness Small and Medium Enterprise Investment Scheme, AXMIS, the bank has released 134.63 billion to 37,571 entrepreneurs. Between September and October 2021, under the Anchor Borrowers Program, the bank disbursed 43.19 billion to support the cultivation of over 250,000 hectares of maize, sorghum, soya beans, and rice during the 2021 dry season, and 5.88 billion to finance 6 large-scale agricultural projects under the Commercial Agricultural Credit Scheme (CACS). Cumulatively, the bank has disbursed a total of 864 billion to 4.1 million farmers, cultivating 5.01 million hectares of land. The bank also disbursed a sum of 41.2 billion for the commencement of the Brown Revolution, a large-scale wheat program to wean Nigeria off imports by 35% during the first year alone. In addition, the bank disbursed a sum of 261.92 billion for 42 additional projects under the 1 trillion naira manufacturing intervention. Cumulatively, the bank has disbursed a sum of 1.08 trillion under this scheme. As part of its effort to support the resilience of the health sector, the bank disbursed 5.39 billion to 9 healthcare projects under the healthcare sector's intervention facility just within September and October 2021. The bank has also cumulatively disbursed the sum of 108.65 billion to hospitals and pharmaceutical industry. 54 of the 117 projects funded are for hospital services. Committee was gratified that the funding under the health sector has resulted in the establishment of 2 new cancer centers in Nigeria, over 59 MRI, and more than 42 CT scan centers all over the country within a space of 18 months. To further promote entrepreneurship development among Nigerian youths, the bank recently approved the implementation of the Tertiary Institutions Entrepreneurship Scheme. The scheme is designed to create a paradigm shift among undergraduates and graduates of tertiary institutions in Nigeria from white-collar jobs towards entrepreneurship development. The guidelines for the implementation of the scheme was recently published, as Bank of Industry is presently partnering the bank for the pilot implementation phase. Under the National Mass Metering Program, 8.69 billion naira was disbursed to 4 distribution companies under the scheme's phase 0. The sum of 47.66 billion has been disbursed so far for the acquisition of 858,026 electricity meters. Also, in furtherance of its intervention in the energy sector, the bank released 27.03 billion to power sector players under the Nigerian Bulk Electricity Trading Payment Assurance Facility Program. This is in addition to the 37.69 billion disbursed to 8 distribution companies recently under the Nigerian Electricity Market Stabilization Facility. The bank has also disbursed the sum of 39.2 billion naira under the Nigerian Gas Expansion Program to promote the migration to produce compressed natural gas as the preferred fuel for transportation and liquefied petroleum gas as the preferred cooking fuels in Nigeria. Furthermore, the bank recently introduced the 100 for 100 policy on production and productivity, PPP, designed to create a flow of finance and investments to enterprises with potential to kick-start a sustainable economic growth trajectory, accelerate structural transformation, promote diversification, and improve productivity in the country. It is geared to support private sector companies with the aim of reducing certain imports, increasing non-oil exports, and improving the FX generating capacity of the economy. The bank will select and finance 100 of such companies at 100-day intervals in line with detailed selection criteria as contained in its guidelines, and roll this over for another 100 companies for the next 100 days. The Targeted Credit Facility, TCF, was particularly highlighted by the committee for its contribution to alleviating poverty at the grassroots in Nigeria. Committee thus urged the bank to continue its support through the Targeted Credit Facility to ensure that more people benefit from this program. With the commencement of monetary policy normalization by the US Fed and impending interest rates lift-off by central banks in some advanced economies, the MPC called on the federal government to intensify its drive towards a counter-cyclical fiscal policy in view of the imminent tightening and external financial conditions. Committee members therefore noted with concern that the gradual normalization of monetary policy by this group of economies will dampen the recovery of several emerging markets and developing economies in the short to medium term due to the sharp reversal of capital flows. Committee also evaluated the development in China relating to the reoccurring pandemic, power outages, and crisis in the property market, noting the likely impact of this could have on Nigeria as a major trading partner. Members thus called on the bank to ensure that necessary buffers are put in place to shield the economy from downside risks associated with this development. In general, members expressed confidence in the ongoing policies of both the monetary and fiscal authorities, which in their view was the hallmark of the current recovery and restoration of macroeconomic stability in Nigeria. They therefore called on both the authorities to look beyond the current position and plan towards attracting sustainable investment flows into Nigeria. The committee's decision. At this meeting, MPC was gratified that its policy actions in the past had started to yield positive results, given the remarkable improvement in gross domestic product, which stood at 4.03% during the third quarter of 2021, and the sixth consecutive month moderation in inflation to 15.99% in October 2021. Given the level of its conviction about the efficacy of its actions on macroeconomic variables, MPC felt that whereas tightening would further help to rein in inflation aggressively, it nevertheless feels that tightening will increase the cost of funds and constrain output growth. On the other hand, whereas loosening will lower policy rates, ease liquidity pressures, and stimulate additional credit creation, which will boost output growth, MPC also thinks that loosening will further widen the negative real interest rate gap and compound the price distortions in the money market, which could fuel inflationary pressures. As whether to hold its existing stance, MPC believes that the existing monetary policy stance has supported the growth recovery and should be allowed to continue for a little longer for consolidation to achieve the MPC's mandate of price stability that is conducive to growth. The committee also feels that a hold stance will enable it carefully appraise implications of unfolding global development around policy tapering and normalization by the advanced economies. Based on the foregoing, the committee decided on a whole to hold all policy parameters constant to support the enabling environment for sustained recovery of the Nigerian economy. The committee therefore decided by unanimous vote to retain the monetary policy rate at 11.5%. In summary, MPC voted to 1. Retain the MPR by 11.5 at 11.5%, retain the asymmetric corridor of plus 100 and minus 700 basis points around the MPR. 3. Retain the CRR at 27.5% and retain liquidity ratio at 30%. I thank you most sincerely for your attention.
Thank you, Governor. That was the communique number 139 of the meeting of the Monetary Policy Committee of the Central Bank of Nigeria. We'll now take questions from the press. We'll start with you, your name, the media house you represent, and then your question.
Good afternoon, Mr. Governor. My name is Ndoka Chejin of the Nation newspaper. The CBN has granted forbearance to banks and their customers over time. This is about to come to an end in March 2022. Now, if the CBN decides to now do away with the forbearance, how are you so sure that this decision will not lead to an increase in non-performing loans? Thank you.
Good afternoon, Governor. My name is Issa Abdullah from New Telegraph newspaper. The economy is on recovery path. Key indices have shown GDP rising, the inflation is trending down. How do you think this can be sustained so that Nigerians can enjoy this improvement?
Good afternoon, MPC and Governor. I am Nancy Naji, the anchor of Morning and Nancy. I have three questions. The first one is a global component of it. Do you and the MPC have concerns about the impact of the US Fed tapering, as well as the normalization decision on the FX reserves? I checked the FX reserves yesterday, I think about $41 billion. Also that decision on the dollar rate and FX rates in general. Yesterday we saw Jerome Powell being announced again as Fed chair by President Biden. The second one is, in the wake of Mr. President's launch of the e-Naira on October 25, the e-Naira is the first African digital currency. I want to know, how is the e-Naira's performance and adoption rate among Nigerians? Then finally, what are the chances of seeing the takeoff of the infrastructure company, as well as the NIFC? I'd like to know where that will be located, and the reorganized Nigeria Commodity Exchange. Thank you.
Good afternoon. My name is Leah Fatumbabatunde, and I report for the Nigerian Television Authority. Barely 4 weeks ago, Mr. Governor, you announced the 100 for 100 policy on production and productivity, and following that, we also got some guidelines. Could you speak further to that, though you made mention of it earlier, the changes we're going to see, how you feel is going to impact on the economy? Thank you.
Good afternoon, Mr. Governor and his team. My name is Chinemere Joseph, the anchor of You and the Economy. My question is, latest figures from the National Bureau of Statistics indicates that Nigeria's GDP grew by 4.03% year on year in real terms in the third quarter of this year, which you highlighted. Now, showing a sustained positive growth over the last 4 quarters since the recession we witnessed in 2020. Without preempting your outlook for the next year, which we expect later this week, when you attend the annual dinner of the Chartered Institute of Bankers of Nigeria, are you optimistic that these figures will continue in this positive trajectory? Thank you.
Okay. I have a number of questions from those are the pressmen who sent in their questions from outside. Now, this one is coming from Sunday Michael of Daily Trust newspaper. Sir, could you give us an update on the success story of the CBN interventions in the critical sectors of the economy? And then the next one, the bank was recently in Plateau State, where the president flagged off the brown revolution in wheat production. In spite of these interventions across the value chains of over 20 crops in the country, some are still of the view that there are no returns on investment, as it were, judging by reports of slow or non-repayment of loans by farmers. What is your view on this? The next question is also from Collins Wednesday of the National Newspaper. He said, recently, there have been cases of deductions of money from the accounts of customers by some deposit money banks without specifying what those deductions or charges are meant for. What is the CBN doing to restrain the banks from such actions. And then finally, from Babajide Komolafe of Vanguard newspaper, there has been a raging controversy about who is the highest individual shareholder in First Bank PLC. As the apex bank regulator, what is the position of the CBN on this? Thank you, Governor.
Well, thank you very much for this set of questions, and I always look forward to an opportunity to provide some clarifications and clearing certain doubts that that people may have in their minds about how we're doing our work and what our responses will be to issues. And I'm happy that the questions that have been asked, I think are broad enough to really respond to some of these issues. The first question from Nduka talked about the forbearance and that it is tapering to an end is going to expire by March 2022, and how are we sure that withdrawing those forbearance or with the expiration of those forbearance regime that NPLs will not rise. My answer would be that if you recall, from our standpoint, we granted a forbearance regime from just two areas. One primarily had to do with the fact that we said that all loans, that people, companies and businesses that are impacted adversely by COVID-19, that they should be given about 2 years. We first of all started by saying 1 year from 2020 to March 2021. And by February 2021, we extended it by 1 more year when the third strain of the virus pandemic continued. We extended by 1 more year, making it 2 years that will expire by March 2022. So 2 years moratorium was one aspect. Another aspect had to do with the fact that we said for CBN interventions that there is a need for us to reduce the interest rate from 9% to 5%. Indeed, another aspect of the intervention or forbearance is that because we knew that the adverse consequence of COVID-19 was resulting in a reduction in the revenue generating capacity of businesses and companies, we also granted the banks an opportunity to allow their customers to ask for a restructure of their facilities. Maybe if it's a 2-year facility, extend it to 4 years, a 4-year facility, extend it to 6 years, a 6-year facility, extend it to 8 years, so as to reduce the impact or the burden of the cash flow on them. At this time, we believe, and those were the periods when there was an unprecedented lockdown of the global economy. All countries, with no exception, were on lockdown. Travels came to zero. People were not allowed to leave their homes. And in Nigeria, this persisted for at least about 3 to 4 months. Now, since from around September, October 2020, Nigeria began a process of easing the lockdown. And notwithstanding the fact that we still saw that around February, March of 2021, that the Delta strain now reared its head, we still said that these businesses should have this forbearance. At this time, we believe that the global economy has opened up. Lockdowns have been lifted, and of course, we know the casualties, the economic damages and fatalities that was caused as a result of the lockdown. And I'm so sure that not too many countries, if at all, will, in the midst of this pandemic, want to embark on a wholesome lockdown any longer. Particularly because most countries are all administering vaccinations that they think should assist.
Mr. Godwin Emefiele, the governor of the Central Bank of Nigeria, briefing on some of the outcome of the Monetary Policy Committee meeting held, which started on Monday and ended today, and this is the last for the year. The committee again decided to leave all interest rate parameters unchanged. MPR at 11.5%, CRR 27.5%, asymmetric corridor at plus 100 and minus 700 basis points around the MPR, and liquidity ratio at 30%. Well, just to round off this conversation, well, I still have with me the past Director General, Lagos Chamber of Commerce and Industry, and the CEO for Center for the Promotion of Private Enterprises, Dr. Muda Yusuf, still here with me in the studio. And out there on Zoom is the Professor of Economics and Public Policy at University of Uyo, Professor Atman Ekwo. Thank you very much, gentlemen, for sticking on. Well, I'll start again with you, Professor Ekwo. Well, the Monetary Policy Committee, or rather the Central Bank, seemed to be quite silent on the issue of the exchange rate, which I believe a lot of people would want to hear. But for you, the outcome that you have listened to, are they in line with your expectations?
Yes, thank you very much. I think the outcome is in line with what I was expecting, that all rates will remain the same, because inflation is trending downwards, so there's no need to look at the to revise the MPR, and the economy is on a recovery trajectory. Although we are still in a state of stagflation, we forget that unemployment is still a major issue, is rising. Inflation is above double digit. So I'm not surprised that all rates are to remain the same. But again, I'm surprised that the issue of the foreign exchange regime is not discussed or touched upon by the MPC or the CBN governor. And because I didn't have time to react to my friend's position.
Please go ahead and react now. Yeah.
Yes. When I say managed float, I mean within that context, the CBN should be able to be efficient in looking at the distortions and make sure that the distortion is not too wide. Because I agree with him, the issue of differential should be considered when it comes to the exchange rate regime. And I think within the managed float regime, you can look at that distortion and close the gap. And let's not forget that when we say subsidy, it's on both sides of the economy, the demand side, supply side. So on the supply side, is subsidy right or wrong? It's debatable, but definitely is right. I think the IMF has taken an extreme position on this matter. We can stay somewhere in the middle. Within that middle, I support a managed float where CBN can now look at the difference by observing the market, look at the differential, and reduce or eliminate the distortion. That could be done. In terms of the MPC, the outcome is what I expected, that all rates will remain the same, because they want the fiscal side to walk the talk. The fiscal policy should be implemented aggressively, and also the investment policies also should also be implemented. Let's not forget, even if the economy is growing, we're in a recovery path, and we are growing positively. We should not forget that growth itself does not imply development. And so the CBN governor has taken a comprehensive look of the entire economy of Nigeria and also the global economy. And I suspect he has avoided the exchange rate issue of posed by the IMF, maybe to avoid controversy. Maybe at a later date, we may decide to take that up.
Okay.
That's it for now. Yeah.
Okay, Professor. Well, Dr. Yusuf, talking about this exchange rate issue, Professor, of course, is disappointed that the central bank is silent on this particular issue. And I'm sure you are as well, because you were looking forward to hearing what next. But then, Professor is emphasizing the fact that, yes, while supporting managed exchange rate, efficiency is key. So what do you have to say on that? And of course, would you have considered, is there any other decision you think you would have considered desirable, at this time, at this meeting?
Well, I think first I agree with the outcome particularly with respect to leaving all the parameters unchanged. given the prevailing economic conditions. I also like to also acknowledge the fact that there was sufficient, a lot of emphasis on what the fiscal side should do around issues of promoting public-private partnership, issues of security, and things like that, and the role of government in exports. I think those are very good outcomes. But on the foreign exchange policy, again, I want to share Pro's position that it's also not good enough that it was not mentioned. Because within the monetary policy space, that is perhaps the most important thing for investors in this economy. Whether you are talking of existing investors or you are talking of, prospective investors. But the impression I'm getting is that the CBN is fixated on its current approach to managing the foreign exchange. That's the impression I'm getting. So perhaps it's like putting a closure to it, that is the position and it's not going to be changed. For me, that is also not a very good thing because it is good to also be inclusive in decision making. It's good to look at the performance and the impact of existing policies. It's good to get dispassionate feedback from all the stakeholders in the economy on how well some policy measures are performing. But I'm not impressed by the fact that the CBN will continue to perpetuate the current foreign exchange policy regime in spite of all the imperfections, all the distortions that is creating. I'm not happy about that.
Well, I guess following from what Prof said, perhaps just trying to be careful not to be in contradiction with or a kind of an argument with the IMF that just released Article 4 consultation, because, I mean, it should be surprising that they didn't even comment on that Article 4 consultation report there. But perhaps maybe later in the year they might come up with some of the policy that will, that will touch on the foreign exchange market. Thank you very much, Dr. Yusuf, for being part of this program. And thank you very much, Professor Atman Igbo, for being a part of this program. I do appreciate your time. All right, I've been speaking to the immediate past Director General, Lagos Chamber of Commerce and Industry, and the CEO of Center for the Promotion of Private Enterprise, Dr. Muda Yusuf, and of course, Professor Atman Igbo, who is a Professor of Economics and Public Policy at the University of Uyo. I do appreciate your time this afternoon. Well, that's where we wrap up the program. Thank you for watching. I'm Chimeze Obi Iwawo.